Hello, this is Jessica Dunn, and this is Economic Development Finance. Today we're going to cover Chapter 5 and Chapter 6 in your Seedman text. So what is working capital? I know that we've covered working capital in previous chapters a little bit, but today we're going to delve into it a little bit deeper. Working capital is very, very important for businesses, and it can be thought of in different ways. First, you can think about it from an accounting and financial statement analysis perspective. It is the firm's ability to pay its short-term financial obligations. So it's concerned with current assets and current liabilities. Because remember, current assets are those assets that you expect to convert to cash within 1 year, and current liabilities are those bills that you expect to pay within 1 year. So from that perspective, net working capital is officially defined as the difference between your current assets and your current liabilities. So do you have enough cash on hand to pay your bills when they come due? There's another way to think about working capital as well. We can think about it from a financing perspective. It would be your required investments in cash, accounts receivable, and inventory. It's how a firm finances its current assets. And so your needs in these accounts can change over time due to changes in your business. So you could have a need for an increase in inventory, perhaps due to seasonality issues. So now you need to build up your inventory, and that's not going to result in sales for some period of time because you're building up in the off season for your big selling period. Or it could have something to do with your accounts receivable. So perhaps you want to start extending credit to your customers. You sell it today and you don't collect your money for 30 days. So you're going to need some cash there to help cover the expenses during that lagged period. But it can also be concerned with non-fixed assets. They don't necessarily fit into neat balance sheet names. So a firm may need to redesign its products or re-strategize its marketing. This would involve hiring people, not necessarily buying assets, but these expenses would not result in immediate profits, and so they would have to be financed. So what are the uses of working capital? First and most important, they provide ongoing investments in short-term assets a company needs to operate. Second, they would address seasonal or cyclical financing needs. So businesses require a minimum cash balance to meet day-to-day expenses and to provide a reserve for any unexpected costs. All businesses have some sort of inventory, whether it's a manufacturing plant with raw goods or a law firm with reams of paper. So we all have inventory cost. And then the seasonal and cyclical financing needs. So we do need short-term assets to generate revenue, and this happens before the receipt of cash. So if your working capital is not sufficient or if it's not properly financed, a firm could run out of cash and face bankruptcy even if they have good ideas, they have a good solid company. If you can't pay your electric bill, you can't stay open. And so here is a picture of this to help you see the flow of cash within a company. So we have a sales order. We produce those goods and services. We deliver those goods and services. We have perhaps sold them on credit, so now we have not yet received any cash. We have collected our accounts receivable, so now we have a statement that says they owe us money, but we haven't actually received anything yet. And then that will eventually be converted to cash. So there's a long lag between the time that you produce or manufacture your goods, and this is where you're incurring most of your expenses, until the point where you actually receive the cash to recoup your cost and to provide you with some profit. So why is working capital important? Again, without working capital, a profitable firm with a good idea, competitive company could face bankruptcy. It's also needed to sustain growth. So without working capital, you can't continue to replace your inventory. You can't extend credit to customers. You can't market or develop new products without cash in the reservoir to make this happen. It's needed to undertake activities to improve business operations and remain competitive. So examples would be product development. That would use working capital. To improve, to have continual improvements in your current products and processes would require working capital. These working capital costs are usually small, they're usually repetitive, and they aren't usually humongous cash infusions required. Working capital can be permanent or it can be cyclical. Firms need long-term permanent working capital. This would provide ongoing positive net working capital situation where your current assets are greater than your current liabilities. To have long-term working capital, a portion of it must be financed on a long-term basis. This would be either through long-term debt or through equity. And a firm may also need cyclical working capital. Cyclical working capital is needed to cover short-term changes in sales due to changes in demands. So, for example, if you are a toy company, the majority of your sales are going to be in December. So you need to build up stock in the summer months to have adequate supply in the winter months. Few firms have steady sales throughout the year. The demands for goods and services fluctuate, and so this does require short-term financing. So there are different ways to finance your working capital. The first would be a line of credit. Second, accounts receivable financing, factoring, an inventory loan, or a term loan, and we're going to go through each of these individually. So a line of credit. This is an open-ended loan. A bank would allow you to have access to a maximum amount of money. You don't necessarily have to use the entire amount. It allows the company flexibility to borrow money when needed for the exact amount of money required. Lines of credit may be secured or unsecured, and it often requires an annual cleanup. So that means that at least once per year your account balance must be zero. So you have to pay it off at least once per year. So the advantages. You can borrow exactly what you need, and it's simple to establish. Most people have a line of credit. I have a line of credit. You can have personal lines of credit, business lines of credit. It can make your life a whole lot easier to have access to cash when you need it. There are some drawbacks. First off, there are fees associated with the line of credit. Now, with a personal line of credit, the fees are pretty insignificant. I think my personal line of credit is $50 a year. But these fees are charged whether the account is used or whether it's not. With a business, they often require a compensating balance. So this means that the company must maintain a deposit account with a minimum cash balance equal to a percentage of the line of credit. So that is a major disadvantage, because if you're having to draw upon your line of credit, it's because you don't have enough cash in your account. So now they're forcing you to draw even more than you need, and depositing a portion of that into your deposit account. So now you're having to pay extra interest. So it effectively forces a higher interest rate. And then the final disadvantage is that if a cleanup is required, if it requires you to have a $0 balance at least once per year, then your line of credit cannot finance longer-term working capital needs. Now, not all line of credits require cleanup. Let me emphasize that. My line of credit does not. My parents have a business line of credit. It does not require an annual cleanup. Accounts receivable financing. It is an amount that is tied to a percentage of the borrower's accounts receivable balance. When an accounts receivable balance increases, the allowable loan principal also increases. The bank receives an invoice copy along with the assignment that gives it the legal rights to collect payment and apply it directly to the loan. So an advantage of this is that as you increase your accounts receivable, so you're making more sales, your borrowing capacity automatically grows. It is a very good alternative to businesses that do not have the credit strength to receive an unsecured line of credit. There are some disadvantages. There are costs associated with managing the collateral. So every single time that you make a sale, you have to send an invoice directly to the bank. And that's costly, both time and money. It also requires collateral, so it reduces the ability to borrow against this collateral in the future. And the collateral here is the accounts receivable. Factoring. This is the sale of accounts receivable to another firm who then collects payment from the customer. This allows a company to shift the risk of non-payment and the cost of collection to a third party. As the company makes new sales, they provide an invoice to the factor. The customer pays the factor directly. The factor then pays the company a slightly smaller amount. Sometimes the factor may advance payment, so they may pay as soon as they receive the invoice. But it depends upon the type of business that you're in and your length of time that you've been with them. So if you are a stable company that's had a long track record of good, solid sales to credit-worthy people, they may be more likely to advance payment. There are some advantages with factoring. So you no longer have the cost of establishing and administering a collection system. You're passing that on to someone else. You're not having to send out invoices to your customers every week. You're not having to be on the phone with collection agencies and trying to figure out how to collect the money that you are owed. Because the factor does this and they do it as a business, they're usually collecting payment for many, many firms at one time. So you're just going to be one of their clients. And so they do this as a business. So they have dedicated staff for collecting payment. And so they can often do this more cheaply than you can. And they can pass these savings on. There are disadvantages, however. First up, the business loses control over the customer relationship. So you may have had a customer who's been with you for 20 years. All of a sudden, they have a death in the family or sickness. They've consistently paid their bills, but you yourself as the business owner have no control over the billing to them. Even though they're a good customer, you've dealt with them many times, you would gladly extend them more credit, more days of credit. You probably won't have that option. And another disadvantage is the factoring costs might be high. So again, it's going to depend upon the type of business that you're in and the amount of sales that you've had historically, as well as how long you've been a customer of theirs. But it may not be the most cheap option for you. An inventory loan. This is a secured loan. The inventory is the collateral. Inventory is seen as more risky than accounts receivable. Firms with an inventory of standardized goods with predictable prices will be more successful at securing an inventory loan than those with a large amount of work in progress or highly seasonal or perishable goods. So the more consistent sales, the more consistent the price, the cheaper the loan will be, and the more access you will have to it. Lenders do have to make sure that the inventory is not sold before the loan is repaid. And there are different ways they can do this. First would be warehouse storage. The inventory would be stored in a public warehouse and controlled by an independent third party. So there is cost associated with that. You would have to hire someone else to come in and track your inventory for you. Another simpler method would be direct assignment by product or serial number. The lender would receive an assignment for pledged inventory that lists all serial numbers, and it may require full or partial payment as these goods are sold. So advantages, inventory loans can be cost effective if your quality is high, if it's standardized goods with consistent prices. Disadvantages, if the warehouse storage method is chosen, it could have high costs. Additionally, either method, it will have high transaction costs and administrative costs, because now you're having to track your inventory. You're having to pay someone else to track it, or you're having to track it by serial number, and that's a lot of communication with your bank. Term loans. This is for medium-term debt. It is repaid over 3 to 7 years. They usually have a floating interest rate, and they can be secured or unsecured, and they're usually obtained through a commercial bank. Advantages. They fund longer-term working capital needs. So, unlike a line of credit that may require an annual cleanup, this is going to be for longer-term needs. And they also have a longer maturity, so they can be repaid over several years, which to you equates to a lower monthly payment. Disadvantages, they often have higher interest rates, and there are often restrictive covenants associated with these loans. I remember we were talking about restrictive covenants. These are rules that a lender can place upon your company while you have their money. So it could say, while we have lent you this money, you cannot pay dividends in excess of a certain percentage of earnings to your shareholders, or you can't sell a specific asset. A whole bunch of different covenants that a bank could place upon your company. And so here this is all drawn out on a table. This is in your text. So we have our line of credit, accounts receivable loan, factoring, inventory loans, and term loans. There's a description here available and a little bit more information. So where does working capital come from? Commercial banks are the largest source of working capital financing. Savings banks, these are more likely to provide small loans. Commercial finance companies, they make riskier loans because they are not as heavily regulated. Asset-based lending, this is a good alternative for firms with a lot of assets but weak credit. Trade credit is very short term, so your supplier drops off goods and they usually expect payment within 30 days. SBA 7A, this is through the Small Business Administration, is their 7A loans. This is a loan guarantee. And the reason why a company would want a loan guarantee, there's a third party that's promising at least partial repayment of your loan. And so it can help you secure loans through other sources such as a commercial bank. Business development corporations, these are for high risk loans, and they're part of the banking industry. And then venture capitalists, these individuals usually provide equity. Some offer debt, but generally they want to be equity partners. You know, you've seen Shark Tank. They want to buy a portion of your company. And this is limited to fast-growing firms usually. I included Chapter 6 in this because it is, in my opinion, basically a continuation of Chapter 5. And so it's going to start off talking about the difference between fixed assets and working capital. Fixed assets are hard assets that support activities, so real estate and equipment. They are important to all businesses, even online ones. Even online places need places to store their goods prior to being shipped. Retailers are going to need storefronts. They all need computers for inventory management. But these fixed assets are going to support a firm's expansion. They're going to support expansion for either increased demand or to reach new markets. Fixed assets are needed because companies are going to need to regularly update facilities and to introduce new technologies. And they provide important secondary business facilities, so administrative offices, R&D, warehouse, distribution centers. But fixed assets are larger in size, they're longer in time, they have a greater impact on the firm than working capital, they're much more expensive, and they're made in larger increments. Fixed assets are also irreversible. Once you have purchased a warehouse facility, it may be extremely difficult to liquidate that without incurring some sort of loss. But these fixed asset purchases are designed to increase your production, sales, and profits. So because they are irreversible, businesses scrutinize fixed asset investments carefully. Lenders face greater risk from the longer term of fixed asset loans versus that of working capital. There are more unknowns. Underwriting is much more careful. Banks do have some abilities to reduce their risk. They can share it, the risk and the reward, with another bank. So there could be two banks coming together to offer a loan, or they could have a guarantee from the Small Business Administration. Working capital, on the other hand, is there to fuel your operations. It's more easily reversed. So, for example, if you have too much inventory on hand, that may be costly, but it's probably not detrimental. So, how do you get fixed asset financing? First up, term loans. These usually have a maturity between 3 and 7 years, and they're used to finance equipment. Mortgage loans are secured with real estate. They have a 10 to 20 year term. This would be similar to your home purchase. A leasehold improvement loan is used to obtain financing for building improvements or rented space, and they can be very difficult to obtain since you technically don't own the building. All you have is a lease. Bonds is a three-way legal arrangement between the borrower, the bondholder, and a trust company, where the trust would represent the bondholders. And we'll get into bonds a whole lot more in a couple chapters. And then leasing. The owner lets the lessor use the property in exchange for money. So there can be two different types of leases. An operating lease. This is short term. The lessee acts as a borrower. A capital lease is long term. There are some advantages with leases. First up, no restrictive covenants. So when you borrow money from a bank, they can impose restrictive covenants. That's not going to be in place with a lease. They may be cheaper, and there may also be a cancellation option. So here are some different financial instruments. A term loan. This is going to be paid over a set number of years with a fixed payment, so usually 3 to 7 years. Leasehold improvement loans, loans that are very hard to get to make improvements to leased properties. Real estate mortgages are secured by land. A bond, this is debt that is sold publicly or privately. So you as a company can sell bonds, which simply is a promise to repay, and you make repayments at a fixed schedule with the lump sum at the end of the bond's life. And these can be sold publicly or privately. And then a leasing. So basically a rental agreement rather than ownership. So sources of fixed asset financing. There are the commercial banks, thrifts, and finance companies. but then there are some additional ones that you may have not heard about before. So the first would be an industrial development bond. This would be used to finance buildings and equipment for manufacturing firms. These are limited to modest size financing for manufacturers. So here are some rules. They can only use $40 million in industrial development bonds for life, and only $10 million in a 6-year period. It's only effective for financing of at least $1 or $2 million. So you're having to borrow at least $1 to $2 million, but not more than $10 million in 6 years, and not more than $40 million over the entire life of your company. But these do offer lower cost and longer term fixed rates. So they're going to give you a very low interest rate and a very long maturity to repay it. So it's going to give you very low monthly payments. The SBA 504 program, if it ever says SBA, that's a Small Business Administration. So the way this works, a private lender would provide a loan for 50% of a project. A subordinate SBA loan would finance 40% of the remaining cost, and then the business would have to contribute 10%. So you would work with the SBA and work with the bank. You yourself as the business owner would come up with 10%. The bank would finance 50%. The SBA would finance 40%. The bank would be the senior lender. So in the event of default, they would receive their money first, and then the SBA. The nice thing about this is that the SBA does offer below market interest rates. Financing gaps do exist with fixed assets as well. So businesses with limited access to equity and little free cash available have a difficult time meeting the lender's loan-to-value requirements. This is most pressing for real estate developments. Another financing gap would be that the actual costs are greater than the appraised value. Lenders like to supply money based upon appraisal. We talked about this in Chapter 1, the difficulty with Lower Town Arts District in Paducah. How Paducah Bank was having to loan money greater than the appraisal value. This would occur because there may be empty buildings that keep rents low, or a firm may need special improvements that increase costs, or rapidly growing construction costs where rent has not yet met up. So costs may exceed appraisal values, cost estimates, and businesses may not have a lot of free cash available. So there are options for fixing these problems. First would be a loan guarantee, where someone would promise to pick up the slack. So if you, as a company, failed, the owner could have signed a loan guarantee saying that if the business doesn't pay, I will. You can get institutional individuals to give you a loan guarantee. The SBA 504 program, grants, equity participants, and so we'll go into each of these in greater detail in future chapters.